Warnings of job cuts here from Wayfair, Citi, Macy's, and Google, renewing that focus on the labor market. Could this be the start of a larger trend? Now, we know the jobs data is closely watched by the Fed, with the latest print showing that the labor market has remained resilient, yet it has cooled from those highs that we have seen over the last 12 months. So what does this tell us about the timing of Fed cuts? We want to bring in Michael Gapen. He is Bank of America's chief U.S. economist. Michael, it's great to talk to you again. So let's start with the Fed cuts, the timing, and exactly how the labor market, the recent developments that we've seen, that how you see that playing into the decision here that we could be getting from the central bank over the coming months. I guess, do you think a March rate cut is still on the table?
We do. We have 4 cuts this year, so 100 basis points in cuts in 2024, but the cutting cycle starting in March. And I think you bring up a good point that the labor market is more important in the Fed's thinking than it was, say, 12 to 18 months ago, when the Fed was willing to endure, in their words, some pain in the labor market in order to help bring inflation down to low and stable levels. But as we moved across 2023 and into 2024, the Fed is seeing actual data that says, hey, we can grow at a modest rate while still seeing inflation come down. So in December, the Fed admitted their reaction function has changed a bit, meaning the more the labor market softens, the more the Fed will be inclined to move to rate cuts and potentially move faster. So yes, the quicker the labor market cools down, the more Fed cuts should be coming.
Is it more about seeing that unemployment rate tick higher to that above 4% and actually 5% forecast that some economists had put out there? Or is it on the other side, if the Fed is able to still have a strong employment situation, but see inflation continue to cool and get to that 2-handle but 2% target that they've put forward, that it's fine if the labor market doesn't deteriorate to the expectation that some economists have put out there?
That's right. I would say the latter composition of your remarks there would be consistent with, the soft landing outlook. In other words, I think the Fed has a stronger vested interest in achieving that soft landing than at any point during the recovery. So as long, the supply side of the economy has rebounded, global supply chains have eased, but more importantly, all the discussion we had, 18 months ago about labor shortages has gone away. The participation rate has rebounded strongly. It's allowed the services side of the economy to expand as rapidly as it has while still bringing down wage pressures. So I think the Fed's of the mind in saying we don't need to step on the labor market too hard, and they would want to lean against any expectation that the unemployment rate needs to rise to 5% or above. Some backup, I think, is warranted, and they would be okay with it, but something in the low 4s is probably what they're thinking. So anything beyond that, again, would lead them in the direction of rate cuts to underpin activity and prevent the labor market from weakening more.
Michael, if we don't see the Fed cut rates in March, I know you are expecting that, but if we don't see the Fed follow through and do that, what does that then do for your prediction or your expectation of a recession? How much does that raise the odds that we could see some sort of hard landing for the economy?
Well, I think if they don't go I think they're close. I think it'll be close enough in March such that even if they don't go, I think all of us would say feels like conditions will be right for them to start the rate cut cycle around the middle of the year. So I think more likely people like us in the March camp would say, okay, they're close, just not there. They need a little more evidence, so let's think June. So I doubt a 2 to 3 months difference in the timing of a easing cycle and normalization cycle would make that much of a difference. But the longer the Fed would delay, the more I would get concerned, because markets have priced in a lot of easing. So if the Fed doesn't validate some of that, financial conditions could tighten, and then perhaps you would risk a sharper slowdown in the labor market.
We were reminded last week, Michael, that as a courtesy, usually more broadly, the Fed in the past has not been in a massive kind of cutting cycle going into election in order to seem, or at least appear, apolitical. But if this is an economy that calls for multiple rate cuts ahead of that, then how for the Fed do they continue to need to make sure that they're kind of towing the line and not seeming overly political?
Yeah, I think in the recession scenario, it's obvious, right? No policymaker wants to be in that world, but what you should do is obvious, right? So if there is, for example, a sharp drop off in employment and we get a negative employment number, it's obvious what the Fed should do, and the data would support them cutting, even if that happened in September, for example. So the weaker the data is, the more obvious it is how they should respond, and that would take kind of election concerns on the sidelines. It is a little trickier if the Fed's cutting on inflation alone while the economy still looks good and strong overall. But I think if they start, again, if they're able to start the rate cut cycle in the first half of the year, it gives them time, I think, to explain what they're doing and communicate why they're doing it. And it should lessen some of those kind of election-related distortions or risks for them. So I think it's something that can be managed. But yes, it'll take some adept communication on their part.
And Michael, we got to go. Just remind us, how many cuts are you pricing in or anticipating this year?
We have a 425 basis point cut, so quarterly pace of cuts for 100 basis points for the year.
Michael, always a pleasure to get some of your insights. Thanks so much for kicking off ahead of the trading session, kicking off the 9 a.m. hour with us. We appreciate it.
Thank you.